Rodger is President and Chief Executive Officer of WSFS and its primary subsidiary, WSFS Bank, and a member of its board of directors. A big, warm welcome for Rodger.
Thank you, first of all, for having me here today. I'm a lifelong Philadelphian. I've spent my whole personal and professional life here. I actually went to undergrad at Temple, graduate school at Drexel, lived in the Center City area before it was fashionable to live in Center City, and have lived the last 12 years just outside of Wilmington as part of my move down there to be part of WSFS, or as we like to say, WSFS. So it's a real honor and privilege to be here today. I have a few comments and a few slides. I'm going to move through it pretty quickly, tell you about what's going on with WSFS, because we think it's a really exciting story for this Delaware Valley area and Philadelphia. But I'm much more interested in answering questions or having a dialogue than doing a long presentation. So, just briefly, I thought you would be interested because it has become big news. On August 7th of this year, we announced our combination with Beneficial Bank. And so I'm going to walk you through a little bit of the background of that, how it came together, why we think it makes such compelling strategic importance, and as I said, answer any questions. So hopefully I'll get this right. Okay, if you're not familiar with WSFS, we're actually, we believe, the 7th oldest bank in the United States, operating under the same name and charter, founded in 1832 for the citizens of Wilmington. Obviously have gone through lots of cycles and turns in our long corporate history, but that's a proud part of our legacy. Today, sitting here today, we're just over $7 billion in assets, 77 offices, primarily in the state of Delaware, and then recently, pre-Beneficial, had started to make a push into southeastern Pennsylvania. We acquired two smaller banks, one in Delaware County called Alliance Bank, which was headquartered in Broomall, and another one called Penn Liberty Bank, which was headquartered in Wayne. It really is part of a strategic push on our part to expand outside of Delaware and into this broader Delaware Valley region. We have four major, they're up there as five, but really four major business lines: traditional commercial lending to businesses, retail, consumers, mortgage, which is part of the retail bank, bless you, wealth management, and sort of a niche, interesting business called Cash Connect. So we're the second largest provider of services to non-bank owned ATMs across the country. Could probably do a whole other presentation about that. It's just an interesting business that was started inside the bank, and if anybody wants to talk about that more, I'd be happy to do that. So Beneficial, you all know the story, also been around forever, sort of the, we like to say, kind of the WSFS of Philadelphia, 165 years old, just like us, the oldest and largest independent bank headquartered in the market, 72 offices, similar business lines, and as you can see, both companies are award-winning workplaces. So this is about the two of us coming together. So the question is, why did this make so much strategic sense? So I'll flip to this. This is why it makes so much strategic sense. Pro forma, our bank will be the sixth largest bank in what we call the Delaware Valley. As you can see on the top line of the slide there, the Philadelphia, Camden, Wilmington MSA by deposit market share. And as you can see, everybody above us and most of the people below us are really good, but really, really big banks where this market is just a small part of their larger operation. So our view is this region hasn't had a full-scale, full-service, locally headquartered, locally managed bank with all the products and services and enough scale to compete with the big banks, probably for 20 plus years. It's one of the only markets in the country that has that dynamic, especially one this large. So we think there's just a tremendous opportunity to fill a void that's been in this marketplace for a long period of time. There's lots of very good banks on that list, smaller community banks who do great work. but they don't have the size and scale that we will have combined. And that's particularly important, as I'll talk about another strategic component of this, which it deals with the rapid changes that are going on in our business, like everybody's business, because of technology. So when we go out and talk to customers, whether they're businesses or consumers, we say, in this region, you have a choice. You can bank with a big bank, or if you want to bank local, with somebody that has all the products and services, see the impact on the community, know the decision makers, you can bank with WSFS. We think that's a compelling strategic position. Most other cities or MSAs in the country, there'd be 2 or 3 companies that would look like us. We're the only one. So we think there's incredible opportunity for now, obviously, what's basically the 5th largest demographic market in the country. So just gives you a good picture of our footprint. Those are our combined branches. The green dots are legacy WSFS. The blue dots are legacy Beneficial. Obviously Wilmington, everybody in this room understands Wilmington and Philadelphia are not far apart, but in some parts of the country, people don't recognize how strategically close we are today and how robust the demographics in this market are, whether you talk about population growth, housing growth, operating businesses, being conveniently located on the I-95 corridor, et cetera, et cetera. So it's a great market. The point of this whole slide is it's a great market, and now combined, we cover that market, very, very well. So this is part 2 of this combination, and really is how this whole thing kind of came together. So the number one question in every bank, boardroom, executive management discussion that's going on across the country, I can guarantee you, is how do we deal with the major strategic issue, which is for decades, banks have made significant investment in what we call physical delivery. You might call it a branch. And now our customers who tell us that they want and value a branch when they choose a bank aren't using those branches. They're using, if I can get it out, sorry, they're using this. So we have many branches where the deposits are growing every year, but the transaction counts are going like this. Because you can do most of your traditional transaction work on here. You can deposit a check, you can make a transfer, you can do, all those kinds of things. So how do we respond to that? By recognizing that we still need branches. We believe that, and we hear all the time that branches are valuable and important for lots of different reasons, which I'll talk about, but we can't continue to have the same kind of investment that we've had in those locations because people just aren't using them. And so as we were working on our current strategic plan, we do 3-year strategic plans. When we were working on this plan this year, we've gotten a room with our executive team. This is all before Beneficial, and started talking about this issue. Well, so maybe we could close a handful of branches, take some of the money and invest it in technology, but how do you compete with people like JP Morgan who spend like $10 billion a year on technology and things like that? And the light bulb kind of went off when the head of our retail bank, who really built the network that we have today, said, guys, we can't do this like incrementally. To do what we want to do, we need like $20, $30 million to continue to invest and stay competitive with the big guys. And right about that time was the time when our CEO, Mark Turner, who I succeeded, he preceded me, was connecting with Jerry Cuddy, who's the CEO of Beneficial. About the same size, same number of branches, dealing with the same issue. And then another light bulb went off, and we said, maybe we can do a lot more together with the scale that would give us than if we were trying to do this on our own. And from that conversation, which really started kind of March of last year, By May, we had signed a letter of intent and we announced the deal in August. So it came together very, very quickly, but we quickly saw the power of what this could be from the prior slide and then this issue of what we're calling a delivery transformation. So as part of this deal, we've announced that we're going to close 25% of our combined branches. It's about 30 branches combined across the footprint. And we're going to take the money, half of the savings from that, and we're going to invest it in technology and delivery transformation. So we could have taken the money and just let it drop to the bottom line, which is typical what banks do in these kinds of situations. We said, no, we have a great product offering today. We feel our mobile and digital and online platforms can stand toe-to-toe with any of the big banks, but things are moving really fast and things are changing, and we need to continue to invest in our platform. And I'll give you some examples in a second about things that we need to do, because whatever the products that we're using today probably aren't going to be the products that we'll be using 2 or 3 years from now, right? You know, the one that a lot of people talk about in the person-to-person payment space is Venmo. You know, Venmo wasn't really even around like 3 or 4 years ago, and I'm sure there'll be some new version of Venmo or whatever 3 or 4 years from now. We have to invest more into our infrastructure if we're going to stay competitive. So it's the strategic relevance of building the largest locally headquartered bank combined with this delivery transformation is why this is such a strategically compelling deal, because it's our view, as I said, that every bank is having this conversation right now in their boardroom, but it's really hard to get your head around it, particularly when you're like closing branches in communities that you've been in for 100 years and things like that. But it's going to happen. There's going to be more of this kind of announcement happening just because, for the reasons I said. People know that there's, you know, they need branches, they just don't need as many of them. And our view is if we can start this now, get this going, we'll be a full step ahead of others who will start doing this as they come to realization they have to do something similar. So it's the second part of this, and this is a multi-year program. This is not going to happen overnight, but it's the second part of this which, you know, I think makes this so different and so, as I keep using this term, strategically imperative for us, because our company had been and has been, we're going to announce, you know, our full year results next week, and through the first 3 quarters of the year, you know, we had a great year, performing very strongly, top quintile, top 20% of the banks in our peer group, really doing great stuff with a very, you know, good diversified business model, great team, et cetera, et cetera. We could have probably kept doing that for maybe another strategic plan or two, kind of call it 5 to 6 years. But by just continuing to do what we did and kind of incrementally, you know, turn on profitability and making small investments here or there, but then we would have hit a wall. And the world would have passed us by, and we would have had a much bigger strategic challenge. This is getting in front of that dynamic. So we all know that how people are using technology. Delivery transformation is a really important part of this for us as well. And I should say, we're going to take a step back on our bottom line numbers this year. So we've told Wall Street and our investors, as part of this deal, this nice trajectory that WSFS has been on, delivering solid growth and bottom line profits, for a couple of years it's going to kind of go like this, and actually this year's going to go down a little bit. But then within 3 years, and we've shown this in some other slides that I didn't include here, we'll be right back where we are today, but we'll be twice the size, in a market 6 times bigger than the markets that we're in today. And we will have, assuming that we do this well, we will have executed this delivery transformation. So that should provide a much, much, much longer runway for us to continue to deliver those bottom line financial results for our shareholders. So we're staking ourselves out there, somewhat because of what we've done, but somewhat because of other factors. I mean, our stock has gotten significantly impacted since we announced the deal. We've been down at one point over 30%. in a year where up until, our fourth quarter results, which obviously I can't talk about, but feel really good about, is probably going to be the best year in the company's history. 30% hit on our stock price. Because we went out and we said to people, we've got to take a step back to do this combination, to do this delivery transformation for the long-term strength and viability of the company. There's lots of companies talk about managing for the long term, but then who really live quarter to quarter, because that's the way Wall Street looks at things. I think this is a testament to our board and our management team that we were willing to do this and say we're going to change the trajectory, going forward. Question? Yeah.
Was it a heavy lift with the board and those on the executive leadership team to think this way, or is everybody already in alignment?
I'd say it was a lift. It wasn't a heavy lift, but as I said, we all kind of saw the same trends. We all saw the opportunity of what it could be to have this kind of a market position. So it just took a little courage to say we're going to take a hit for a little while, because we know when we set ourselves out there as a company to deliver on goals, that we've delivered on them. And we know that, as I said previously, if we don't do this, at some point down the future, we'll be faced with a much bigger challenge. So, yeah. I'm just keep talking. I'm just going to grab my soda here. Yeah.
I think the perceived need for branches is generational.
Yeah.
I think people my age perceive a need, but if you talk to my kids who are in their mid-30s who don't go to brick and mortar stores anyway,
Yeah.
I see where you're going.
Yeah.
The other thing is, I'm sure you know, on Walnut Street in Philadelphia, 3 new bank branches have opened up on the corner of 16th or 17th and Wall.
Yeah.
And they're coffee shops. 2 of them are coffee shops, in which banking is also
Yeah.
conducted. And the third one is the Citizens Bank branch, where there's no lines anymore. You walk in, you sit down at a desk, and you talk to a
Yeah. No more. There's no more
So-
tellers. That's like, you can't say there's no such thing as a teller.
Can you talk about the whole social aspect
Yeah.
of banking that seems to be changing also in these branches?
Yeah. So thank you for that question. It is everybody. What you're seeing is everybody trying to figure it out.
Yep.
We all know all the things that you just stated are absolutely happening. So how can we reconfigure branches? How can we reduce the footprint? How can we change hours? How can we offer other services that will make them relevant? We got a lot of attention when J.P. Morgan said they're going to open up 50 branches, in this region. What does that mean? How are you going to compete with them? Those kinds of things. So they're a big bank. They're a great bank. They have great products and services. To us, that was a validation of our strategy, because what they were saying is, we're coming to Philadelphia in the Delaware Valley, but we're going to do it de novo. We're going to build all these branches. And we said, we're already here, and we're going to do this acquisition, basically trying to accomplish the same thing. So everybody's trying to figure it out. I think there'll be more unique and different concepts, but it's all kind of getting at that same issue. Our belief is there's certainly some perceived stability and brand value in having a location that people know they can go to if they need to. And there's just certain things that happen in your life where you probably are going to want to look somebody face to face and have a conversation about it. Could be a good thing, like buying a house, which we know is, for all the stuff that they talk about, like Rocket Mortgage and all that stuff, tell you almost all their mortgages are not closed and settled digitally. They start the process there, and then they put you into, a regular process. Let me just finish for a second. And then, so it could be for good things like that, or starting a business, or it could be for a not good thing. Something happened to your account. There was fraud. Somebody, did something to your account. You had a bad check, something like that. Do you want to get on the phone and have a conversation with somebody and Skype them? Yes, some people do, but a lot of people still want to go in and talk to somebody, and they would prefer, even if they're having that conversation, that it's the person that they know is in their local branch, so that if they want to go in, they could also go have that kind of a conversation.
I think if you're going to reduce branches, you've got to make it easier for a person calling to get from dialing the number to getting to a live person. Because that can be a very, as you know, dealing with anybody, it's a very frustrating process.
So part of this delivery transformation, this isn't on the immediate docket, but I can clearly see a time and place where through your phone, you could set up an appointment or talk to somebody that you know that you've previously set up on your phone and look at them. That's the kind of stuff you'll see happen. I'm sorry.
No. I just wondered, with the 35 branches, do you own the real estate, or what happens to those 35 branches? Or do you just put them up for sale? How does that work? What happens to them?
So it's a mix. Beneficial owned more branches than not. We leased more branches than not. So obviously we are obligated to pay out the lease, or if we own them, dispose of them, the way that we see fit, and they get repurposed. So there'll be a process. We're not doing that, closing those locations till the end of the summer. So there'll be a process once those locations are closed that they'll get repurposed into other banks or other things, or whatever.
Is there a negative view by the community when you close these branches down? And I'm asking that question, I'm wondering if you could turn those branches into something positive, where they might be like WeWork, where you could have a set of places where startup companies could go and work, and change them over to something like that, where you're creating jobs in the community, as opposed to just shutting it down.
Yeah, so
Nothing's there.
almost every branch that we're closing, there's another, what will be WSFS branch within 5 or 6 miles. So there really isn't a huge impact on the community. They can't credibly say, like, you've abandoned us and there's no place to go. You just have to drive maybe a little bit further than you used to. And we have done things like that. So in the Penn Liberty acquisition, we took one of their locations and made it a learning center out near Westchester. And it's primarily for our associates, but we open it up to the community. And then people from the community can come in and use it as well. So we do look to do those things, but I would generally tell you our philosophy has been, we're not in the real estate business. We don't know real estate well. There's other people who know it well. We'd rather do what we need to do and kind of move on and let somebody else do something that would be beneficial to that, that property.
But you don't manage it.
That's correct. First of all, there's going to be a turn in the economy. We all know it. It's been longer than any normal economic cycle. We're 9+ years out from the Great Recession. Most economic cycles are 8 years. So we know it's going to turn. Unfortunately, we don't really know when that's going to happen, because while people talk about later this year or 2020, there's really no good, hard economic data that really you can point to as a leading indicator that says we're headed into that now. It's almost as much, we know there's some negative things like tariffs and disruption and things like that, but there aren't economic stats that would give any indication that that's coming. When I talk to our commercial customers, the people who are in business, the number one issue across the board, we were just with a big local electrical contractor, general contractor, yesterday in Wilmington. Nobody can get help. There's like a labor shortage. It started out as a skilled labor shortage. We used to hear like 4 or 5 years ago, you can't get a welder, you can't get certain skills and things like that. Now it's just like, there's not one conversation that we have with a business owner when you say how things are going, they're saying good. It could be great if I could find more labor. So low unemployment, labor shortage, inflation kind of under check. It kind of doesn't indicate just yet. Of course, this will probably be like the kiss of death, and you'll all remind me of this in a month or two. There doesn't appear anything that we can point our finger to. But we know it's coming, and the way that you prepare is obviously coming out of the recession and all the regulatory changes. We have much more robust risk management functions within the bank, compliance functions within the bank. Our balance sheet is much stronger. I think the industry's balance sheets are much stronger. And the one thing I will say about the regulators who went way too far, as a result of the crisis, they really have forced us to up our game from a risk management standpoint, have a lot more resources, a lot more ability to deal with it. So I think when it will come, first, it will not be anywhere near as big as the dip that we had in 2009. And I think the banks are much better positioned to deal with it as a whole, and would include us in that. Yes?
Yeah, appreciate it. I'm obviously coming at it from a financial technology startup point of view, and I think actually am a WSFS customer through your partnership with SoFi, even though I
Oh, great.
don't live locally, but I'm a SoFi cash customer. But yeah, I would just love to get your point of view on how a bank of your size does compete with some of those larger folks who are investing a lot more either into their own in-house built solutions or partnering with third parties to be able to nimbly bring new solutions to your customer base.
So it's a great question. It's really kind of like the fundamental question, because we can't compete with the investment dollars that the big banks have. I mean, it's just huge. And most of what they're doing is R&D, right? You know, these huge R&D functions. JP Morgan has a whole building off of 202 in Wilmington that used to be an AstraZeneca site that's just people figuring out, you know, the next stuff, you know, kind of thing. It's a spectacular facility. But what we can do is we can link our customers to that whole world of that fintech space, all the R&D that's being done in Silicon Valley and other places which are coming up with products and services, and marry those two together. So if you went back 3 or 4 years ago and you talked to these fintech companies, SoFi is a great example of it. We're going to kill the banks. We're going to take the banks and we're going to put them out of business because we got better technology and we've got all the bells and whistles and all that stuff. And I think what they've come to realize is you can spend a lot of money building the greatest product. If you don't have customers, what's the point? And really there's been a 180 on this part of the fintechs where they've said, instead of trying to kill the banks, why don't we partner with the banks? Bring our technology to bear with their customers and their infrastructure, and together we can be, you know, better. So the dynamics change. So our R&D is, we will do it with the fintechs, but we just got to do it differently. So part of this delivery transformation, you see some of the things that we're doing today and things for down the road, is building an architecture that will allow us to basically plug in and plug out apps, for lack of a better description, that our customers are going to tell us they want and need a lot more quickly than we can do that today. We outsource our whole back office. There's 3 big companies, technology companies, that serve most of the banks. Ours is FIS, and so we outsource it with them. They're great, they're a good partner, but we're just one of hundreds of banks that use them, and when we want to do something, we just kind of get in line, and it takes a couple of years, and we have to go through their whole vendor management and other process. We need to be able to move, you know, a lot more quickly. So the premise of what we're trying to do is, build the architecture and the infrastructure allows us to plug in and plug out. So as an example, the first thing you see on there is WSFS Everyday Pay. So on our mobile app, you can do almost everything you can do on Venmo. And our folks saw this coming like 3 years ago. We went to FIS and we said, we want to have a person-to-person payment app because this is the way people are doing things today. They said, that's great, we're working on that, we'll be back to you in 6 months. And they came back to us in 6 months and they said, now you can get in the queue. And we got in the queue, and then, bless you, and then you had to go through compliance and vendor management. So all of a sudden, it's like 2 years later, and we roll out WSFS Everyday Pay. I'm here to tell you, there's not a lot of people who use WSFS Everyday Pay because they don't know it. They know Venmo. So like that's my point. Like the world moved past us while we were trying to figure things out. We have to have the ability to move, you know, to move quicker than we do today. And so that's part of really what this delivery transformation will all be about. And that's how we will compete. We're not going to have an R&D function. We're going to allow others to develop the products and then deliver our customers so that jointly we can do things together.
Yeah, I mean, and you know this, but I mean, we built ours from day one, white label, private label, configurable APIs to be able to integrate that way versus trying to go around things.
So I think you hit on, is it Lee? Lee? Yeah, you hit on the really big point of this for us. It's all about new entrants into the banking market. You know, we do a great job with our existing customer base, and we obviously have the products and services, but the people, either they're college graduates or new business owners, we have to be able to grab more of that market share, and we're not doing a good enough job on that today, because it's not just having the products and services, it's having the perception that you're going to continue to have the products and services. you know, my personal opinion is the reason you get all those apps updated from Netflix and Google, you know, where they're fixing bug and they're adding, they don't need to do that every 2 or 3 weeks like it seems they do it. They're doing it because they're trying to give you the impression that they're at the leading edge. They're constantly updating, you know, what they're doing. And that's what people want to have, is to make sure that they have that functionality, what's at the leading edge. And so part of our job is to make sure that not only we have the product services, but we can give the comfort or the confidence that we will continue to be right there with the big guys. That's what we're trying to do. So a number of products and services, things that we're working on. So we're spending $32 million. That's half the savings from the branch closures over 5 years. So it's 3 times what we would normally spend in what we call non-routine technology expenses. We've done these partnerships before. You mentioned we have a partnership with SoFi, the student lending company. We're helping them roll out their deposit product. There's a digitally based home equity lender here in Philadelphia called Spring EQ. They're based out of the Sears Center. We have a partnership with them. And then we also have a partnership with a student lending company called LendKey that does our student lending. And we'll be working with a partner. We can't do this all on our own. So part of $32 million is we're going to have a big-time consulting firm who's done this at other banks, you know, work with us because, like I said, we can't do this on our own. So delivery transformation, big part of this. This is a slide that just kind of summarized a lot of why we think this is so important. You see delivery transformation, the financials, why we think this is relatively low risk. A lot of very important components. And this is what it's all about. I don't have to read it. That's the strategic rationale. And I would tell you that our whole, and I work some of the time now at 1818 Market, the Beneficial headquarters, which will be, you know, part of WSFS coming up here soon. Our whole combined team is just incredibly excited because most of us, including myself, started our banking careers at small community banks that got rolled up through mergers and acquisitions into larger banks, and it lost what we all came there to do and serve. And now we feel like we have that perspective to bring to bear with this opportunity to create this bank for this region, the only one with the size and scale to do it from a competitive marketing position. So happy to answer any other questions. I really appreciate the dialogue, so please.
So with consolidating 25% of the bank's branches, how do you also reduce staff? Do you change the way that you're, you know, with all the millennial and the online stuff, are you beefing up that side and, you know, reducing? What happens on the employee side? Yeah, so there's definitely some staff reduction because of that. But I will tell you, I think it's actually one of the interesting parts of this transaction. So we have both banks have about 25% attrition in our bank branch staff as it is. So we've actually offered everybody in the retail customer-facing bank a job. Because we announced the deal in August, we gave those offers out in November, but we're not doing that conversion until late in August. And we know just through normal attrition and other things, there will be opportunities for everybody. We just can't tell them which location just yet, but we said in your region. So we don't really think at the end of the day any customer-facing retail folks will not have an opportunity with us. Really where we're seeing some of the cost impact is more in some back office functions and things like that. And clearly we're reallocating to some of the areas that you talked about. Yes?
Yeah, I see, this is more of a curiosity type of question. I see a lot of banks being opened with names I never heard of before, a little.
Like WSFS?
No, but, you know, names that, and it seems like keep coming up. Is it their strategy to build it, then hopefully be bought out by a larger bank? I mean, is that a strategy of theirs? Because why come up with another bank right near you?
don't have a good answer for that. I mean, everybody thinks they have a business model and a catch that's, something that's different. I think our industry, coming out of the crisis, we've been losing about 300 banks a year, and there's basically been no true traditional banks that have gotten started, partially because of the regulatory environment, partially because if I came to you today and said, do you want to put money in this startup bank? And you'd say, how am I going to make money doing that with everything else that's going on? So the banking industry has contracted dramatically as a general statement, and I think some of that will continue. I think what you're seeing is more kind of alternative players and other things who are trying to take advantage of a technology catch or something like that, and that's what you see is sort of playing off of the anti-big bank thing. Yes.
You mentioned that Chase is coming in, and did you mention they're doing de novos?
Yes, well, they're building their branches, right, the 50 branches. Yeah.
Well, I can say from past experience, because I was with Citibank when they tried their de novo.
Yeah.
And, it did work.
Yeah.
Obviously, they're not here any longer, so I think you guys are in a very good position we know the local area, because while at Citibank, it was a tough position. They didn't know us, and actually, again, did not trust us, so
Yeah.
I'm not worried so
Thank-
much about that.
No.
Have they approached you about buying some of your branches or leasing some of your branches?
No.
They haven't approached you at all?
No, I think they want to do their own thing, their way. But it's interesting. So Citibank did something similar. I think not as significant or probably as well planned as what J.P. Morgan's trying to do. But so they came into the market. They opened a ton of locations, spent a fortune, as you well know, and then they decided to exit the market. And they literally just left the market. Like, if you went to one of their branches on Friday that was open, and I don't think this is an exaggeration because we actually went and took one of their branches, on Monday, there was a piece of paper on the thing that said, this location has been closed. If you have any questions or comments, www.citibank.com. Wasn't even like go down the street or call this, like that kind of thing. So we were fortunate. So if any of you are familiar with media, they built a beautiful branch right downtown, right off of State Street, kind of right up against where the Trader Joe's is there. The landlord of that branch, because they were collecting rent now for the next 20 years or whatever from Citibank, we couldn't even believe, this again speaks big bank, we wouldn't believe that they wouldn't, in their agreement with the landlord, prohibit another bank from going in there or doing whatever, just left it. So we went in there that we're subletting it for like half the cost, and we have this beautiful location in one of the best parts of media. And it's just an interesting,
Yeah, well, 2008, they heard Citibank during that period.
Right.
But one last suggestion, maybe change your name to People Saving Fund Society. You'll have a perfect WSFS sign right here. You don't have to spend a dime.
Actually, we've asked, because we said we've got 3 of the letters down. We'd only have to change 1. So we actually inquired if that those letters were for sale, and they're not. Yeah.
Landmark.
Yeah, it is a landmark. Yeah.
This is a little self-interesting question. This is in the Beneficial Bank customer.
Oh.
Has the list of bank closures been sent yet?
Yes, it's been announced. Yes, there was a public announcement. Yeah.
And they're all going to get a WSFS name on it, right? Beneficial's becoming WSFS.
Yeah, so it'll be one brand, going forward.
And when does that physical stuff start happening?
Last weekend in August of this year. So, as I said, we're just in the we've received shareholder approval, all the other approvals. We're just waiting on regulatory approval, which we hope to get here in the near future. So we're targeting a March 1st close. And then for 6 months, we'll be one company, but Beneficial branches will continue to operate. WSFS branches will continue to operate. And then 6 months later, we'll do the whole simultaneous systems conversion and branding conversion. The reason that we're doing that is, we could have just done a close and conversion the same time, but on a size and scale of what we're looking to do, particularly when we're closing 25% of locations, it takes time to educate the associates, to educate the customers, for everybody to get comfortable that this is what it's going to look like on the day you do the conversion. So we said it's worth it to wait 6 months, plan it and do it right, so that, knock wood, that day you do the conversion or that weekend when you do the conversion, people are, okay, I get it, I understand, and they're comfortable with it, as opposed to rushing to it. And it kind of speaks to what I was saying before. We could have rushed to it because that would have delivered the cost savings quicker and delivered the bottom line numbers quicker. But if we had a hiccup and we alienated a bunch of customers, that would have been, played against us forever. It's more important to us to do this right over time. This is a long-term strategic, multi-year, opportunity for us. 6 months is going to change that dynamic.
Great, thank you.
Thank you. It was great.